Thanks for tuning in to Talking Point. I'm your host, Neeraj Shah. There has been a liking that the market has taken to residential real estate companies or real estate companies at large, with the belief that the strong cycle of consolidation or a downtick in the cycle that we've seen maybe all through 2012 has finally come to an end, and we might, for varied reasons, start seeing an upcycle. Now, we've done a number of these conversations. Of late, though, what has intrigued me the most is the market finally saying that let's try and make a distinction between companies that operate largely in the southern part of the country vis-a-vis the others. And we thought, let's get in a company which may be operating largely in the southern side of the market, but also has some presence within some of the other areas like Gift City, Ahmedabad, and others. And to talk about, therefore, their view on how do they see the cycle and what would individually be Brigade Enterprises' growth plan, we have Atul Goyal, the CFO of the company. Mr. Goyal, good having you. I hope all is safe.
Yeah, thanks. Oh, yeah, all is safe. You are right. I think southern companies have been doing very well, and resi demand is very, very high in southern towns. It's mainly because ITS is doing very, very well. And I think southern market is one of the markets where most of the developers are more organized, and that's why they have been very successful. If you see, the consolidation in the industry has played a big role for this impetus in the sales, which has come into the all listed players of grade A developers, I should say that. And of course, affordability is again a big chunk. Today, if you're getting a loan at sub 7, I think that is a big reason for a demand which has come into the market. And of course, developers who have a history of delivering on time, I think people today are coming to them and booking their requirements. So I think with a lot of new vacancies being filled by IT companies, I think demand is going to be there. We did a decent 0.74 million in Q1. Though we had a lockdown in Resi, I'm talking about in lockdown, but we did around 1.6 in Q4. So I think again the demand has come back, and we are seeing a very good quarter in Q2 also, and we hope that this demand sustains going future also. So I think residential is going to stay, and we are very, very hopeful. And I think that's the reason we had done a QIP for 500 crores, and we are going into the market and sourcing the land for residential wherever possible. I think we have been primarily in Bangalore centric player, but we have gone to Hyderabad and Chennai. Now we are seeking more land parcels in Chennai and Hyderabad, so there is more diversity in our residential play for us. Of course, you said Gift City only we have a hotel and office vertical there, so we don't intend to do any residential there. And our intention is very clear that we want to stick to our southern markets going future also. The strategy is very clear.
Okay, Mr. Goyal, let me try and break this up into piece by piece. Now, because of the tech-first nature of the business, the belief is that not only the volumes in the southern market predominantly, or the IT hubs of the country, and it could well be NCR and Pune too, but largely Hyderabad, Bangalore, and maybe even Chennai would start seeing not just volumes of the units, but maybe the size of the offerings as well as the price inelasticity because of the demand, and that being available to the developer might be seen going ahead. Now, my question to you is this. Are you sensing, while Q1 was COVID impacted, you still did well, Q2 onwards, are you seeing all of these three? More inquiries, larger sizes of the flats, and the price that you wanted to sell, you're able to sell at that. Are all these three happening?
Yeah, all these three is happening. I think First, yes, demand is there. If you'll see our Q2 results, it is going to be a very, very good quarter. So we are, the demand is there. People are coming and buying houses, and I think it can also be one of the reasons that two-tier developers are not much in the market, and people are coming to grade A developers. So I think that is a very, very major key reason. As far as sizes of flats are concerned, there are all type of developers who are there. Like Shobha does a deluxe residential, or maybe you can say luxurious residential. We are in the mid-side apartment area, and that is doing very, very well. Actually, for a say apartment value below 2 crores is doing very, very well. And I think the average size can be in the range of 700 square feet to 2,000, 2,200 to 2,500 square feet. So I think that that part is doing very, very well. Thirdly is that, see, pricing depends upon the location of the project. So where the project lies, it depends upon that. But yes, today customers are willing to give prices for whatever we are selling. I think there was some luxury residential finished inventory we had in OMR Bangalore, and that has been going very, very fast. So I think demand is there, and luxury is also going now. It is slow, but major demand is in mid-income housing.
Okay, Mr. Goyal, the reason I squeezed in the pricing piece is that at least 2 years ago, or if my memory serves me correct, the conversation was about the high inventory and what quantum of discount would the builder give you if you go and sit in front of the builder with the checkbook. Now I hear that developers are saying we are not in the market to give you discounts. Yes, we can adjust a little bit here and there, but largely the price points will be maintained and the prices could be raised. Is that actually the scenario in your end of the market too? It was there in MMR. I'm trying to understand how is it shaping up in the southern market.
No, I think you are right. There's a recent study from Anarock. It's very, very clear. All your finished inventory everywhere is going down very, very fast, except NCR, where because of the unfinished projects, that finished inventories or the inventory is lying there. Otherwise, inventory is going down everywhere. And I think today, no discount is being given by the developer is right. Today, people are coming and buying at the price which we are giving. And what developers or like us, what we are doing is we are launching projects into phases, because we have to take a RERA approval for all the big developments, and we do building by building. And we have seen that we are able to increase prices when we launch the next building in a project. So I think we have taken price rise of around 3 to 4%, and we hope that we'll be able to continue to take price rise in future as well.
Is this price hike in order to mitigate the cost of the raw materials, or do you reckon that you would actually expand your operational metrics despite the rise in cost of steel and cement, arguably? I know the cost may have come off a little bit, but still on an average, I'm trying to figure out.
No, it's on the both sides. See, what you can sell is what market can take. So cost is your problem. It is not market's problem. So market will give price what you will demand or what your project will demand. But there is a demand, and I think we are able to increase the price. Yes, there is some cost escalations, but there is mainly in steel. In cement, more or less it is same. And when we are devising a project, we keep around 10% of contingency in our project cost. So I think that will take care. So right now, I don't think so. Margins are going to get affected that much going forward for all developers. At least for us, I can say that.
You reckon margins can move up?
It can. If prices move, definitely margins will also move, and we are seeing that in various price increases which we are taking, margin is definitely moving up. And the one of the classic cases that in our case, our residential loan has been going down for last 7 years. Today, we are at 200 crores of residential loan which we have. What we are doing is the cash flow is so fast that you can fund the project from the cash flow which is coming from the customers. So the saving on the interest cost is very, very high. Generally, for a project cost around 5, 6 to 7% is their interest cost, which is being saved by the developer because there is a good cash flow, and good developers are trying to churn that cash flow into the project. And of course, now RERA being there, you have to deploy that 70% into the project. And we have been very disciplined in our deployment of funds in all the projects which we have.
Got it. Mr. Goyal, last couple of questions really. We haven't even done too many project-specific conversations, but that's okay. I wanted a bigger picture from you this time around. So in your conference call, I believe you guys highlighted that you would do annual launches of about 7 to 8 million square feet. I want to understand from you, how could the Brigade P&L look like 3 years out if you continue doing 7 to 8 million square feet launches? And I presume if you've just done it recently in the call, you would have thought about this 18 months out. So let's assume the next 2 years you do launches of 7 to 8 million square feet. You do very little leasing out, or maybe you do more, but I heard you say that you want to focus on southern market residential real estate. So I'm presuming outright sales would still form the bulwark of your overall sales. How do you see the picture moving up because of the increased demand, stable pricing, and arguably more offtake from people?
So this is a misnomer actually. The problem is you do accounting on India as 115. It is not POCM anyway. So it doesn't get reflected in your books. Today the problem is you are doing accounting based on your registration. So that whatever we are launching today, the profit will not come into the books. They will come at the time of completion.
Agreed.
Yeah, but okay. but definitely.
I'm not asking for a quarterly run rate, year on year, etc. What's the basic idea that you believe? Let's say in terms of volume sold, if not actual numbers booked, how do you see the run rate moving ahead?
Run rate of the sales, or
yeah, run rate of the sales maybe.
Give us
an idea your way, Mr. Goyal. We are happy to buy your line.
No, see, it's very difficult to say. There was a pandemic for first quarter also. We did around 4.6 million last time. Definitely, we are looking to up that target this year. And every year we are trying to increase 10 to 15% of incremental sales we are trying to do. So let's see how the market behaves there. But that is what our target is. And this time, also this year, we are targeting that we should close our 4.6 million. Secondly is that, see, two big developments we have done. That is with GIC, of course, is Tech Garden and WTC Chennai. So there, both has a potential of 400 crores of rental, which is going to come. In case of Tech Garden, already we are getting some 70 to 80 crores of rental now. And WTC is also going to, the rental has started. Amazon has already started. Some Caterpillar and McKinsey will also start. So by next year, we'll have a full potential of rental also coming from these two properties, and that will change our balance sheet, because today you see a lot of interest and depreciation. Our major loss in our balance sheet is interest and depreciation because of the capitalization of this project, and rental have not started. So as and when rental starts, you can see our balance sheet will be changing very, very fast. And you will see a good profit which will be coming from the leasing vertical, and of course residential. Since we are doing the sale, whenever we do the completion, we'll definitely there'll be profit which will be there. Resi has been always profitable. What the problem was, because we were in the capex cycle, so leasing there was always a cash profit. Today also it is a cash profit, but we'll be covering our depreciation also when all this being done. Hospitality has been challenged, but that's a very small portion of our business. But slowly, I think hospitality should also increase. We are into operational cash positive there. So slowly, that is also improving very fast.
Suffice to say, Mr. Goyal, that FY23 could look very good for you because your interest cost will come off, depreciation goes off. And I presume in the call you mentioned that you expect the entire leasing for both of the properties to happen in the next 3-4 quarters. So yeah. FY23 could see a full impact of that revenue coming in as well. So there's actually a double effect for you, I presume.
Yeah, it will not be a full impact. I can say partial impact, because rental start will have it will not start at one date. So it will have but yes, definitely majority of the rentals should be there in our P&L by end of FY23.
So FY22 will obviously, because of COVID reasons, do much better than FY21. And you presumably are saying right now that FY23 could be substantially better than even FY22.
Yeah, you are correct.
Okay. One last question. You've done a QIP. You're scouting for newer land parcels. I presume you, if I'm not wrong, reduced some bit of debt as well. And please correct me if I'm wrong there. Is this it when it comes to equity fundraising, or do you reckon you will need to raise some equity money over the course of the next 12 months?
No. It's there. We need not raise any equity funds now. We have already raised 500 crores because we expanded our resi portfolio. And I think that money is enough to sustain us for next 4 or 5 years for our land bank requirement, for our resi requirement, because it's a combination of JDA as well as the straight buying. Of course, in commercial right now, we are not buying any land, so we'll have to see how to go forward, because we have a very strong partner in GIC there. So I think this QIP money will definitely be used in the resi land buying. Of course, we have retired some loan. One is in the Gift City, because Gift City was not doing well. Office was not doing well. We thought we should retire that loan. And of course, after that, Gift City has started doing very well. I think we have done 40,000 square feet in last 2 months, and demand is there increasing day by day. So I think that is the only debt we have retired. Otherwise, resi debt we have been funding from our internal accruals, and we have been repaying that month on month.
Well, who doesn't like a positive surprise, Mr. Goyal? I'm sure you're happy with it as well. But
yeah.
But this was lovely talking to you, Mr. Goyal. Thank you so much. This is the first time that we've spoken on BloombergQuint. Look forward to have you more often. All the best for the quarter.
Anytime. Thank you. Be safe.
Thank you. And viewers, thanks for tuning into this conversation.
Thank you.